May 28, 2019, it's Tuesday, guys. After a long weekend, this is what you're probably thinking. Is the market going to crash this week? Is it going to go higher? What is it going to do? Guys, I want you to consider a very simple possibility, which is always overlooked by traders. What if the market does nothing? I mean, absolutely nothing. What if it does not go lower? What if it does not move higher? What if it just stays where it's at today pre-market, which is basically plus minus a few points? So that is not a good environment to actually trade directional options. And for that reason, we may not be doing a whole lot of trading today. We would rather wait till tomorrow or the next day when certain conditions are going to be met. So with that said, we do think there is actually a summer tech crash coming. It's just not going to take place today, guys. Now, some key observations for May 24th. Top observations are consistent selling in Apple and semiconductor stocks. This selling in Apple resembles very much the selling in Apple that we have witnessed in October, November, December 2018. It keeps gapping lower, and every time it tries to bounce, it gets destroyed. And not only Apple, but the whole semiconductor sector is doing this. Now, for those of you who have not taken the AVGO trade and just completely missed out, please make sure you do not short AVGO this morning because it's hitting some key levels. And it just, guys, after the stock dropped 70 bucks from where we started shorting it, it's a bit too late to get on this trade. So we'd rather wait and find and identify some new opportunities, which there's some really cool earnings that we're fixing to see after hours in the cloud sector. We can spot the right reaction. We put some really good trades throughout the week. Now, also we noticed a huge shift from what institutional investors are doing. Remember, it just seems like not so long ago, the healthcare stocks like UNH, United Health, and Humana, what were they doing? They were crashing like crazy. Remember some of the really cool trades that we're able to place on the short side on these stocks? Well, guys, we're seeing that this behavior is changing. It's clearly changing. So we actually seen healthcare stocks are rallying while the technology sector is having a very, very difficult time to rally. So what we're really saying is institutions are taking money out of tech, out of growth stocks, and they're placing them back in this dividend yielding stocks like utilities and healthcare. So when utilities and healthcare typically going higher, I mean, that is an indication of a couple of things, which we're not going to get into a detailed conversation. It's a whole subject for another video, but just know that there is a shift going from the way the institutional money are relocating their investments right now. Now, what we're also noticing is not only the market seems to be stuck in a trading tunnel, but also is with VIX. And so VIX is so weak, it actually makes a probability of an unexpected crash much higher. Remember, crashes, they don't happen when everybody's expecting them. They only take place when nobody can foresee a certain event coming up that could trigger the crash. And sometimes they happen totally uneventless. In other words, there could be no event that could take the market down. It's just one day you wake up and, you know, that's what happened in 1987, which takes me to a whole nother subject, guys. I'm fixing to reveal in the next couple of days a really cool video that's going to show you multiple reasons of how the conditions in the markets right now highly represent the same market conditions that we've had before the crash in 1987. And I'll jump just a bit ahead. The main conclusion of my findings is such that we may actually not get a crash in October or November. We may actually get a crash during the summertime. So don't get too excited though. Don't go out and buy a ton of puts this morning. It would really pay to wait and until we get the right signals. So watch out today for some key levels. We could easily test 2805 level, and depending on what time of the day that actually takes place, it's going to give us an indication of whether we're really going to break below this 2800 level or not. So here's the two scenarios to consider. One, we hit 2805 in the first 30 minutes of the open and we bounce back. That is actually going to be bullish because, again, the more times the market retraces to a lower level, and it's trying to take that level and break that level lower. The more times it's doing that, it's unable to do so, the higher the probability of a bounce. So an indication, if we get a quick sell-off on lower volume against that 2805, and we bounce, that actually sets up for a rather positive week, or what could be looking overall positive really would just without any huge moves to the upside or the downside. Now here's another scenario I want you to consider is watch out for the markets about 3:45 p.m. In other words, if overall we open higher and we trend somewhat higher, but we're unable to break that level of 2840, 2842, we could have a very substantial move lower going into the end of the day. Yes, we're looking for a move 6 type behavior going into the close today. And if that is the case, then we definitely want to start buying some put options there, because that sets up for a nice indication that tomorrow we could open with a gap lower. And today we're not taking any earnings trades, but tomorrow, guys, there's some really cool stuff that's coming up. We're going to trade some companies like Workday that are announcing earnings after hours, and clearly we don't want to buy options ahead of time. What we want to do is observe the initial reaction first and then put on the trade. So here's the chart of Humana. So as you probably know, if you've been following most of the technology stocks, they're dropping, or they're really not going higher, while some of the healthcare stocks are doing what? Well, they're steadily, look at these volume bars, right? They're steadily going higher. The accumulation is steadily going higher. Typically, you would see this in an environment where we're actually expecting further rate cuts. Clearly the yields and the bonds have been dropping, so on. So they're actually putting money in this dividend yielding stocks. So typically when you observe that, that is a sign that probably a rate cut is actually going to take place in September. And what we've discovered looking at some of the historic examples, once that rate cut does take place, we could get a quick move lower followed by a quick move higher. So in other words, we're looking at some really awesome trading conditions over the next few months, and we certainly don't want to pull the trigger too early on some of those developments. So there's 3 days remaining in our calculations from last week, but clearly if we're getting the sideways trend for the next 2 or 3 days, that could really pause this potential drop. So there's a few things we're going to be taking a look at, and anywhere you look at actually right now, all we can clearly see, there's just case after case after case of a move 11 behavior, guys. And we're going to look at a few charts in a minute. Remember, the main observation right now, what's happened in the market, which makes us overall bearish, not necessarily bearish today, but overall highly bearish in the market, expecting the stack crash, is the fact that the longer the indexes stay under the blue line, remember we've been following that in the last few videos, the probability, the longer they stay under the 50-day moving average, the higher the probability we actually will get a break lower. And so each day goes by and we just keep staying under the blue. And this is exactly what happened on Friday, right? Another day under the blue, actually presented this time by a black candle. So things are deteriorating. The market conditions are deteriorating. Everywhere we look at, move 11 behavior, 11 head and shoulders. Just look at this. This is a very well-defined head and shoulders, guys. And what's happening right now is we're building out this shoulder. So we could be going sideways in the shoulder formation for a number of days until it will resolve in a break lower. We really need the volume in order for that to take place. Remember, we said there was a critical day for Amazon. Well, after Amazon breached that level of the blue line, remember, Friday had a really tough time bouncing at all in what appeared to be a market that was really trying to move into the green zone pretty much all day. So we get another, a substantial move lower the next day. And what happens Friday, it stays under the blue line. So remember, the longer things stay under the blue line, the probability that over the course of a short-term time frame, they will actually resolve to a move lower rather than higher. So Amazon, this would have been now 2 days under the blue for Amazon. And if we get another day under the blue today, tomorrow, it will break ultimately at that level of $1,800. But we don't want to just go and short Amazon this morning. We want to see exactly how the markets will develop themselves throughout the day. So the trading range that we have been observing over the course of last couple of weeks, of course, have been the high trading range of around 28.93 and the lower trading range of about 28.05 to 28.26 level. Now, we're noticing that there's a possible shift in the trading tunnel, so I'm going to skip a couple of slides we've analyzed the last couple of days, guys, and just going to get right to the point here. So we've had a pretty wide tunnel here, right, between the 2890s and the low 2800s, and it seems to be shifting. And the shift that we're noticing in the tunnel, VIX is having a hard time breaking above 1819. It does not mean that it's not going to do it this week, but rather complacent weeks, VIX oftentimes has to do with the low volume. So until we get some volume, we could be in this much lower trading tunnel between the range of 2805 and 2842. So in other words, the higher trading range of the tunnel is now going to be replaced by this level right here, 2840, 2842. So it would make sense to really hold off on building any big positions until we get a break lower, either below 2805 or above 2842. So keep your eyes on your screen today. Observe these levels. If all of a sudden we're seeing a huge increase in volume as we're getting to this 2805 level and we break below it, yes, that would be a great time to actually add some puts. Now, what's likely to happen today is we're just gonna keep fluctuating in that range, plus minus 10 points. And that's not a desirable market environment for trading directional options, guys. We really want to wait because if you slightly miscalculate your entry, this is what's likely going to happen. Your option is going to decay. What you're paying for it today is not going to be what it's going to be worth tomorrow if the market keeps trading in this lower tunnel range. Okay, so it really would pay off to hold off until one of these levels is broken to the downside or the upside. Now, again, if we consider all the charts and everything, most of everything, 99% points to a break lower. What we don't know is could we actually stall out here for a few days before that move lower is going to take place. So it would really pay to short the market, let's say on Thursday or Friday morning around these level of 2840. If we're going back and forth a few days, plus minus 10 points, right? Your options are going to be significantly less on Thursday morning or Friday morning, and that's how you're going to be able to get much larger gains on your positions. Here's week 7 of earnings, guys. What we're watching after hours today is YY, which is a Chinese stock, Workday, which is a cloud-related play. Tomorrow we got some more Chinese companies, a couple of retailers starting to have more cloud stocks like VEEV. Okay, we've got some retailers, and we've got some heavy hitter right here, PAMW, in the security sector, cybersecurity, that is. We got some usual spot suspects here like Sanderson Farms, chicken producers. We got some more retailers. So Dollar Tree and Dollar General all reporting. Really big day on Thursday. So I would really just, looking at this plan of action right here, guys, it would really pay to hold off till we see some really clear patterns right here and make a Thursday and Friday your biggest trading days this week. So if you need to run an errand, if you need to help your wife out with something, if you need to, stay in the office a little bit longer, today would be a good day to do that because later in the video I'll show you it's most likely going to be a move 5 or a 6. If you studied the 13 markets move formula diligently, that move 5 you want to just stay out because these smaller moves in the market, they're not going to generate huge gains. Let's review the market move. On Friday, it was a move 11. Here's why we've recorded it as an 11. It's probably been a very confusing move to a lot of you guys, so let me just break this down. Sometimes you really want to just kind of calculate overall, including the pre-market action, in order to lock these moves properly. So clearly we had a behavior, what appeared to be a move 2, right? We pop, we drop. But then market really doesn't finish in a negative territory, right? So ultimately, if we put the two dots. The significance of the dots should be such that the market opens and closes really at about the same level, which is a characteristic of a move 11. But overall, just like in the prior case last week where we've been going over some of these move 11s, you're going to have a pyramid. You have a pyramid formation right here. You have another pyramid formation intraday right here. You have another pyramid or resemblance of a pyramid going into the close. So you got three smaller moves 11 inside of these bigger move 11 right here, guys. And remember, we opened and we closed right at about the same level, plus minus a couple of points. So when you're trying to map these moves and you're really trying to nail them, keep an eye on where the market closes, where it opens, how do these two levels relate to each other. And if they're within a few points away, a lot of times, that is definitely characteristic of a move 11. If you've seen all these other pyramids intraday, and if you look at the pre-market action, and you got one big pyramid here, guys, you're looking at a move 11. Now, 2-day sequence is 311. Looks pretty bearish. So we get a gap down, followed by continuous pop and drop, pop and drop, pop and drop, which is basically what move 11, what move 3 is. And then we get another pop and drop, right? We hit this high level of 28.42, and then we finish lower than that. Now, the 5-day sequence, oh boy, look at this, guys. Now, this is where things get really interested, right? So when we're talking about a tech crash this summer, now, it's not typical for markets to actually crash in summertime. The last time we actually had a miniature crash during summertime was in August of 2015, where nobody even remembers that. The markets really, literally dropped 1,000 points in one day. But they've recovered the losses so quickly, nobody even remembers it, or just a few people do. So overall, we keep getting these moves 11s, which are top information. So you got 11, 7, 11, 3, 11. I mean, definitely the bears are in control of this market. This is how it looks on the chart. So you get the 11, you get one bullish move followed by 3 bearish moves in a row. Overall, that's highly bearish, guys. Now, what we really want to look at is the calendar for May, because typically this is not how May looks. Guys, I'm not going to give you any detailed breakdowns. You're welcome to calculate it yourself if you want, but just generally speaking, take a look at this. Okay, so far, we had 17 trading days, and look, I've got this move 6 already kind of plugged in. That is my expectation for today. It doesn't mean that a move 6 is going to happen, but that is just something that I'm targeting. That is something I'm calculating. It could be a move 5. It could be another move, but really, if we calculate all the moves, starting with the beginning of the month, out of really about 17, 18 trading days, majority of the days, they are red, meaning that doesn't mean the market was in the red, but based off the 13 market moves formula, we've had a bearish move on such day. And the calculations roughly as such, if we're to calculate the ratio of the bearish moves in relation to the bullish moves, you get close to 68% bearish. And that is an environment that is indicative, because we're still trading close to all-time highs, that a rather larger move lower is definitely in the cards. And each day where we're getting an 11, especially if we're getting a 6 today, guys, so watch out between the hours of 2 and 4 p.m. today. If it is indeed we're going to see this move 6, remember when the markets were starting to crash heavily, it was a move 666, 611, 6, referring to October, November, December last year. So same developments we're observing. The more these 11s and 6s we're going to collect, the higher the probability that that move lower, a big break lower, is just about to happen. It clearly does not necessarily mean we're going to get a 1,000-point drop this week, but if we keep logging these top information type moves, it gets us very much closer to that level. I mean, out of 17 trading days, guys, check this out. I mean, you got 1, 2, 3, 4, 5 move 11s. I mean, it's basically 30% of your moves here, they're move 11s. As a matter of fact, I went back a few years. I can't find a month where we'd had this many 11s in any given month. So this tells us something is coming. What we don't know is 100% whether it's going to take place today or whether it's going to take place Friday or Monday. But we're going to keep track very carefully of anything that's happening right now, especially any type of increase on volume on the days lower. And that should give us a really good idea of when to actually jump in with bigger positions. Now, temporarily, VIX is rather complacent. And it could be deceiving because everybody thinks, okay, we're going to hold this level of 2,800. The bulls are saying, hey, nothing to worry about. We're going to have lower interest rates. And, the market really, we're not talking about 1929 crash, or we're not talking, you remember the crash in 1987 really took place over just a number of days, and then the market recovered, a lot of the losses rather quickly. So we may be heading into a situation where not necessarily every sector is going to crash, right? Because clearly we're observing that the institutional money is going into utilities, it's going into, healthcare stocks, those dividend yielding stocks, and they may not be crashing, but if the technology and the banking sector and some of the other sectors are crashing, then we could get a rather large size move rather quickly. And so that's what we want to position ourselves for. But right now, the fact that people are complacent, that nobody thinks that, nobody's buying protection. Oftentimes, the crashes happen exactly where nobody's actually expecting them. So historically, your typical crash time would be September, October, November, those months, right? That's when the VIX is spiking. That's when your probability of a crash is much rather higher if you look at the history. But I think we may actually get a crash in summer. So that's exciting, guys. I'm pumped. That means everybody's going to make a ton of money because when markets drop, they do drop much faster, which aligns with trading weekly options that just create much larger returns for you if we target these moves precisely. So the VIX, this is how complacent it is, right? Nobody thinks the market is going to drop below this 2,800 level. Nobody's buying protection. The VIX is just there. However, we are observing that it keeps trading in this tunnel between 15 and 18, and it's likely to continue doing so over the course of the next few days. So as we identify in our trading tunnel the level of 2805 and the level of 2842, the equivalent level in the VIX would be the level of 15 and 18. You ultimately want to put bigger positions if we are breaking above 18 on the VIX, and if we are breaking below 15 on the VIX. To be more accurate, you really want to put more rather bullish positions if we're breaking 14.42 on the VIX, and that was shown in the prior few videos. Okay, next market move, meaning for today, guys, we're expecting a move 5, which you know what you want to do. If you love fishing, you should go fishing. If you love golfing, you should go play golf today. You really shouldn't be doing a whole lot of trading, and if you are doing some trading because you can't control your fingers. They're just on the keyboard and they're just, you're telling them to not place any trades, but they're just there and they don't obey you and they're just going in because you have to trade. Go see your wife or your girlfriend, and just see if they got an extra set of handcuffs for you today, because those would come to good use on a move 5 type day. But with that said, okay, we're clearly not suggesting to jump in any trades early in the day. However, between 3 and 4 p.m., if we're noticing the behavior of a move 6, what we really want to do is start building. Notice I'm not saying, build huge positions. Start building some positions on the put side if we're observing this move 6 type behavior going into the close, because that's going to give us a higher probability of a move lower pre-market tomorrow. So the key takeaways are this, guys. Stocks don't break key levels lower, like the level we're talking about clearly is this 2800, 2805 level. Stocks don't break levels like this on low volume. And what we're observing today, remember earlier I was showing you a picture of Amazon pre-market, and it's like trading on 8,000 shares. The stock is up like 10, 15 bucks, but only on the volume of 8,000 shares. Like that is actually the lowest volume for Amazon in months, if not maybe a year. So that tells us, even though VIX is actually spiking this morning, last time I checked, it was in the upper 16s, it's probably not going to hold those levels, and it's likely to lose a lot of these gains. So if you are holding VIX calls, I would rather see you get rid of them, especially if they expire today. Sell them in the morning, collect some gains, and then just watch the market. Again, we want to trade small, or ideally not trade at all, until we get a clear break below 2805 or above 2840, 2842. Watch for the move 6, 315, reversal lower, and especially pay attention to volume. If that move 6 comes in on heavy volume, that is your sign to actually get into some puts. And the key observation is we could be stuck in this range. Now, a different trading range. Clearly, these numbers have changed. Now we're looking at a trading range of 2805 to 2842, and we could be here for a few days. And the ultimate question of the week is, will the market hold the 2800 by Friday? With that said, guys, take it easy today. Don't trade huge. Don't go crazy. Just hold off for a second. Let's get some clear signals, and let's build some bigger positions once those signals are 100% apparent. I wish everybody great success trading today. I'll see you guys tomorrow in the next video.